Traders are always searching for an edge in the markets. They want to find reliable strategies to navigate the complexities of price action. One such approach combines the power of harmonic patterns, Fibonacci retracements, and candlestick analysis. This potent blend forms the Gartley, Engulfing, and Fibonacci strategy. This strategy offers a roadmap for identifying potential trading opportunities with a higher probability of success. Harmonic patterns, like the Gartley pattern, are geometric price patterns. They reveal the underlying harmony and predictability within seemingly chaotic market movements. These patterns are based on Fibonacci ratios. These ratios occur repeatedly in nature and the financial markets. The Gartley pattern, when identified correctly, can provide valuable insights into potential trend reversals and price targets. To enhance the accuracy of the Gartley pattern, traders often incorporate Fibonacci retracements. These retracements help to pinpoint precise entry and exit points within the harmonic pattern. By combining the Gartley pattern with Fibonacci levels, traders can define clear risk-to-reward ratios and improve their trading decisions. This strategy goes one step further by incorporating candlestick patterns, specifically the engulfing pattern, to confirm the trade setups. At the heart of this strategy lies the Gartley pattern. This pattern, named after H.M. Gartley, is a bullish or bearish chart formation. It consists of 5 price swings labeled X, A, B, C, and D. Each swing is interconnected by Fibonacci ratios. The pattern starts with an impulsive move from X to A. This establishes the trend direction. A corrective wave then takes the price from A to B. This retracement should reach the 0.618 Fibonacci level. The price then moves from B to C. This leg should retrace to the 0.382 or 0.618 Fibonacci level. Finally, the price moves from C to D. This aligns with the 0.786 Fibonacci retracement. The completion at point D presents a trading opportunity. Traders look for reversal confirmation. This can come from candlestick patterns or technical indicators. Fibonacci retracements are a powerful tool. Traders use them to identify potential support and resistance levels. These levels are derived from the Fibonacci sequence. In this sequence, each number is the sum of the 2 preceding numbers. For example, 1, 1, 2, 3, 5, 8, 13, 21. In trading, Fibonacci retracements are applied to price charts by measuring the distance between 2 significant price points. Traders then divide this vertical distance by key Fibonacci ratios. These are 23.6%, 38.2%, 50%, 61.8%, and 100%. These ratios are believed to represent natural levels where price reversals are likely to occur. When combined with the Gartley pattern, Fibonacci retracements provide critical entry and exit points. The 0.786 retracement level of the XA leg often acts as a significant support or resistance zone. Traders look for price to reverse at this level, confirming the completion of the Gartley pattern. Additionally, other Fibonacci levels, such as the 0.618 retracement, can be used to set stop-loss orders or identify potential profit targets. Section 4. Engulfing candlesticks, confirming the trade setup. While the Gartley pattern and Fibonacci retracements form the foundation of this strategy, candlestick patterns play a crucial role in confirming trade entries. Among the many candlestick patterns, the engulfing pattern is particularly effective. It provides a clear visual signal of potential trend reversals. The engulfing pattern consists of 2 candlesticks. The first candle represents the prevailing trend. The second candle completely engulfs the body of the first candle, signaling a potential shift in momentum. A bullish engulfing pattern occurs after a downtrend. It features a small bearish candle followed by a large bullish candle that engulfs the previous candle's body. This pattern suggests that buyers have taken control, indicating a potential upward reversal. Conversely, a bearish engulfing pattern occurs after an uptrend. It features a small bullish candle followed by a large bearish candle. This pattern signals that sellers have gained dominance, indicating a potential downward reversal. Section 5. Implementing the strategy, a step-by-step guide. To implement the Gartley, Engulfing, and Fibonacci strategy, follow these steps. First, identify the Gartley pattern. Look for the 5-point structure, X, A, B, C, D. Apply Fibonacci retracements to the XA leg. Focus on the 0.786 retracement level as point D. Look for engulfing candlestick confirmation at point D. This confirms the trade setup. Determine the entry point and set a stop-loss order. Place the stop-loss below the engulfing candlestick for a buy trade. Establish a profit target based on the Gartley pattern. Finally, monitor and manage the trade.